When it comes to transaction costs, everyone talks about spread and commissions, but swap is seldom mentioned. If you hold your positions for many days or weeks, swaps can erode a chunk of your profits. So in this video, I will explain what swaps are and how you can calculate the different types of swaps. When trading with leverage, you borrow money to open your positions. When your position is left overnight, you will either pay or earn interest on that loan. This occurs between 11 p.m. and midnight or 4 to 5 p.m. New York time. For Forex markets, the main driver behind swap rates is the interest rate differential between the currencies. If the currency bought has a higher interest rate than the currency sold, for example when you long the dollar-yen, you will receive a swap credit. Market sentiment, or anything that signals a likely interest rate change, such as economic reports, can also affect swap rates. Before calculating, always refer to the symbol's specification, which has all the information you need. You can access this by right-clicking the symbol under Market Watch. Swaps can be expressed in terms of points, percentages, and dollars. I will go through the calculations for each type later. Notice that the long and short rates are not symmetrical, but are usually skewed to the downside. This is because your broker and its liquidity providers take a cut of the swaps you pay. Retail trading is a negative-sum game. What is this evil triple swap day? Forex markets are closed over the weekend, but your interest will continue to accumulate. Since Forex trades have a 2-day settlement period, your interest for the weekend will have to be paid on Wednesday. And no, you won't get a refund if you close your position before the weekend. In general, for Forex and spot metals, Wednesday is the triple swap day. For energies, stock indices, and crypto, Friday is the triple swap day. If there are upcoming trading holidays, swaps may temporarily increase since interest is collected in advance. When checking the specification, note the swap rates will change slightly on a day-to-day basis. Different brokers will offer slightly different swap rates, and you should consider swaps together with spreads and commissions. Now let's figure out how to calculate swaps in points. This most often applies to Forex and spot metals. Here's the formula. This will give you swaps in the quote currency, which is the second currency in your Forex pair. I'll illustrate the calculation with this euro-dollar trade, which was opened on a Wednesday and closed the following day. On that Wednesday, the euro-dollar long swap was minus 6.75 points. 1 point of the euro-dollar is 0.00001, or 1/10 of a pip. With one standard lot of 100,000 units, a 1-point move represents $1. The point value is therefore $1. 0.1 lots were traded, and although the trade was held only for one night, it was a Wednesday, so triple swaps were incurred, producing a $2 swap debit. Next up is a short on the dollar-yen, which has a $5.99 swap debit. Swap short was a minus 28.32 yen. For yen pairs, 1 point is 0.001 with a point value of 100 yen. Once again, it's triple swap Wednesday, giving us about minus 850 yen. Remember to use the quote currency when calculating swap in points. Using the end-of-day dollar-yen value of 141.83, this converts to minus 5.99 US dollars. Next up is gold with its brutal swaps. Long swap was at minus 37.55. 1 point in gold is 0.01 with a point value of $1, producing over $11 of swaps for a single night. That's it for swap in points. Easy so far? Now let's talk about percentage-based swaps. The idea is to take your contract value and multiply it by the annual interest rate divided by 360. Most brokers use 360 instead of 365, though the difference is minor. Let's try this with Bitcoin, where longs have a swap of minus 10% annually with a triple swap on Friday. The contract size is 1, so the contract value is simply the 0.1 lots multiplied by the end-of-day Bitcoin price of 43,348. Plugging in the 10% swap, we get a debit of 1.20. Triple swaps don't apply here since it's not a Friday. In this case, it's obvious the currency in question is USD. But if your broker uses percentage-type swaps for Forex symbols, the number applies to the base currency or the first currency in the pair. Now on to the final type, swaps denominated in currencies, the most straightforward one. Here I have a Nasdaq 100 trade that was opened on Friday and left open over the weekend. Swap short is a plus 1.363, and triple swap is on Friday. Plugging those in, my net worth has increased by a whopping 41 cents. So, seeing that most of the time you will incur a swap debit, you must be wondering how you can minimize swap costs. The best way to avoid swaps would be to trade intraday, meaning you close all your positions before midnight. Nonetheless, I can't recommend switching up your trading style just for this. Intraday trading requires the most entry and exit precision and could be impractical for part-time retail traders. Do some broker shopping to compare transaction costs. Some brokers peg their swap rates to those of competing brokers, hence swap rates tend to be quite similar, with spreads and commissions usually making more of a difference. Some brokers offer Islamic or swap-free accounts, meaning you will not pay or receive swaps. In return, you will likely incur administrative fees or higher spreads. In any case, your broker will have to pay swap fees to their liquidity providers, even if you use a swap-free account. Rest assured the money will come from you, one way or another. If trading conditions appear too good to be true, be wary of hidden transaction costs like spread spikes and poor fills. On a related note, swap abuse has become quite popular. This occurs when you open a normal account with one broker and go long on a high-yielding pair like the pound-yen, collecting swaps in the process. If you simultaneously short the pound-yen with a swap-free account, either with the same or with a different broker, you get a zero-risk trade, with the net profit being your long swaps. Of course, brokers can easily track this on their servers, and your swap-free account will likely be terminated. In general, I think it's silly to open a swap-free account just to avoid swaps. Just treat swaps as a normal cost of trading and focus on earning legitimately. That's all, folks. Hope this video helped. For trend following or mean reversion strategies, check out the playlists on the right, and see you at the next one.